Welcome to this short video about how managers and entrepreneurs can make use of a cash budget. You can use this to help answer sort of questions you might have about your business or another business you're interested in. Questions like, is our plan for the next period a good plan? How can we improve it? Will we have enough cash to keep us going over the next year? If we are likely to run out of cash, how can we avoid this? First of all, let's just go back and think about what a budget is. It's a record of plans for the future, which has already been agreed by the management. Now, the budget process involves all various parts of the company, but you end up with the three statements down at the bottom of this chart, and the one we're interested in is obviously the one on the right, which is the cash flow forecast or the cash budget. And our cash budget will look like this. It's pretty simple. You have your cash in first, the cash out follows it, then you've got the net cash, and you use that figure to keep a track of how your cash balance will go. This is usually done for a year, and it's quite often done with 12 columns for each month and a total one at the end. Now let's have a look at a simple example. So we've got Mary here. She owns a greengrocery shop. At the beginning of January, she has £10,000 in the bank. Now her plan for January is to sell goods for £5,000 and pay 3,800 for the goods and running costs. So remember the cash budget, we have the cash in first and the cash out underneath. So here's this nice simple one. She's only got £5,000 coming in the period. She's paying out 3,800. So her net cash in is £1,200. Add that to her opening balance of 10,000, and she's going to have a better balance at the end of the month, a balance of £11,200. Now, is this a good plan? Okay. Well, how good it is depends on what she wants or what she needs. This is an increase of £1,200. Maybe she wants £1,500. If she wants £1,500 instead of £1,200, she could consider perhaps selling more products if that's feasible, or raising the price, or paying less if she can negotiate a better price or find a better source. And once having resolved that, she can then redo her cash budget, which will then hopefully end up with a projection of £1,500 coming in. Okay, so let's move on to a more complicated example. Susan plans to set up a new business selling office furniture. She's going to start off with £40,000 invested. She's predicted her sales for 6 months, her purchases as well. She's going to buy a van. She's going to have to pay utilities, wages, other expenses. Obviously, this is fairly simplified, just so we can do this as quickly as possible. Notice that one lot of expenses, the last ones, are paid for on credit, and the rest will be cash transactions. Okay, so here's her projection for 6 months. There's the cash in first, the cash out next. Take one away from the other, take the 48,000 going out away from the 50,000 going in. There's a net cash flow of £2,000. It's a startup business, so there's nothing to begin with. And at the end of month one, she's got £2,000. Notice about 2/3 of the way down, the other cash outs, those were the things that were bought on credit. So there's nothing in month one, and it starts off with month two. So that's the £1,500 to pay for the stuff she actually got in month one. Now, is this plan a good one? Well, it's got some good features. The cash from sales, it keeps going up. There you go. and the net cash also goes up once you're starting from month 2. So apart from 1 and 2, it goes up. So that looks good. Okay. Will she have enough cash to keep going over the next 6 months? We've touched on the weakness here, because there you are at the bottom at the end of month 2, and she will apparently run out of cash. Okay, she's planning to spend more than she will have, which, unless she has an overdraft facility, which is unlikely, cannot be done. Good news, however, is that there's only 1 month with that problem. If we can fix that problem, it looks good. So, how can she fix this? Okay, just looking at that, there are 2 big issues. She's only got to find 2,500 for month 2, and the 2 big numbers are there. So let's look at the van first. That's the biggest expenditure in month 1. If instead of buying the van, she leased it, that would spread that out quite nicely. I'm sure that would reduce her expenses by more than 2,500 over the first 2 months. Looking at the biggest overall cost, which is the goods for resale, that's a very big number. Can we do anything about months 1 and 2? Well, yes, we can. If you look at the sales in months 1 and 2, they are only £30,000, but the purchases are £35,000. So even if she was selling them at cost, she would still end up with £5,000 worth of inventory at the end of month 2. If she reduced that to only 2,500, that would reduce her purchases by 2,500, and that would deal with the problem we have. There you are. I hope you found this video useful. Further details can be found in the book by Ralph Whitaker. Thank you.